Kitco Mining special coverage of Xplor is brought to you by Radisson Mining.
Welcome back to Kitco Mining's ongoing coverage of Xplor 2025 in Montreal. Joining us now is Peter Krauth, publisher of Silver Stock Investor and author of The Great Silver Bull. Peter, welcome back.
Ernest, always a pleasure. Glad to be back.
It always is, and it is actually a great time to be a silver bull.
It is.
So the big breakout happened. Last year when we were speaking, silver was around $33. Today, close to $49 and peaking around $54 not so long ago. So we're still hovering close to all-time highs here. So I guess the question on a lot of people's minds, and this also relates to gold getting pretty well above 4,000, and now we're kind of hovering on both sides of $4,000 an ounce. Can silver really go higher from here, given that we're at almost all-time highs?
So my short answer is yes, absolutely. And to qualify that a little bit, you know, if you look at the last two times that it reached 50 or close to 50, 1980, 2011, both of those times we had parabolic rises. This time we had it might feel parabolic to some over this, especially the last, say, 6 months or so. It has been a very, very sort of steady rise, and you had some days full dollar gains, but this is a lot more steady in terms of approach to $50. It's a lot more sustainable. We had it meaningfully past $50, up to $54, as you said, and now still hovering near that level, even though it has pulled back. So very, very different kind of approach to the $50 level. And, I've said that that was going to be a milestone, a huge milestone for silver. It had been until recently, till it took out $50. It had been the only metal that had not meaningfully surpassed its 1980 high. That's now the case, although, again, it has pulled back. But I do believe that it's going to regain 50. 50 will become a new floor, and for various reasons we can talk about, move considerably higher from there.
All right. Now, another major driver for all the precious metals has been the interest rate cycle. So we were looking at this time last year. We were looking at the Fed had just started to cut, and now they had taken a pause for much of this year, but these projections were, okay, we have falling inflation. The Fed is in a position to cut because inflation is under control. And this is, of course, very positive for precious metals. Now we're in an environment where inflation is sticky and ticking higher, and the Fed is still cutting. So how does this change the previous calculation of what you could say an ordinary Fed cutting cycle would be doing for metals like silver?
So it's interesting to note, if you look sort of on a larger time scale, pre-COVID, inflation hovered around 2%, averaged, let's say, around 2%. And I remember distinctly the Fed and other central banks were almost desperate to get inflation to pick up. We had rates at zero for some time. We had negative real rates. And now, since post-COVID, we're averaging closer to 3%, which is 50% above their target. Their target is still 2%, I think, unrealistic, but so we're hovering at 3%, and yet, as you said, they're cutting rates. So I felt over the past year, at least, that the moment, and I figured it would come around this time, late this year, likely to see them start cutting rates again. And we have that now. And yet, as you said, we have them cutting rates in the face of either high and rising inflation. So I had been saying that was a bit of a situation where you investors would say they've essentially given in, right? They have to choose between employment and inflation, and so they've chosen to support employment and sacrifice inflation, sacrifice the dollar, and so. Since they're cutting, supporting employment, and again, as I say, in the face of high and or rising inflation, that's just a nirvana for for precious metals, and that's why you've seen them. I think that's what gold and silver were sniffing out for the past, say, 4 to 6 months. We've seen it come to fruition. It's a bit of buy the rumor, sell the news. The news has happened. And so we've seen this pullback. It had gotten, in my opinion, I told my subscribers, I feel this is getting overheated. It went farther than I had expected, but we do see it pull back now. I'm happy, frankly, to see that. I think it's healthy. It's a good, healthy correction to see both metals come back. And I think it's a time, short, sort of near-term period where we're going to see these gains being digested, and then we're going to start to eventually move higher.
All right. So let's get into the details of the supply and demand picture. Let's maybe starting with demand. So obviously the big story for several years for silver has been solar demand. So solar demand and the solar build out, electrification, and this has been driving demand on the industrial side for a number of years. Now, some estimates see that the build out in China in particular could be plateauing. But you've pointed out recently that IEA estimates of demand have been consistently undershooting, and this in an environment where we have year-over-year massive growth. So why is that? Why are our best metrics of demand consistently below the reality year after year?
I believe that these forecasting groups they purposely try to remain conservative. They want to maintain credibility and not sort of over promise, so to speak. And so you're right. Yes, through the 2010s, we've seen that the IEA kept projecting 5 years out. Each year that they would project for the next 5 years, if you look back with the benefit of hindsight, they were off by 2/3. So installations were 3 times what they had been predicting. And this was year in, year out. So it is possible that solar installations in China could be slowing. I'm not sure about plateauing. Maybe at least the rate of growth is slowing. But there are some things to consider. First of all, you've got this, we've talked about this before, but you've got this new technology that's kind of taking over. These are acronyms, but the established one is was PERC. Now the new one is TOPCon. Already last year, I believe, 63% of new solar panels were being produced with this new technology. That requires 40 to 50% more silver per panel. The reason you would do that is because they're more efficient. It justifies the higher cost per panel. You're getting more energy output from that panel. So although the producers, the manufacturers of the panels, have been for decades thrifting and trying to reduce the amount of silver that goes into each panel, I believe that we're going to start to see that trend up. In other words, they will probably start consuming more silver per panel. It'll take some time for this to show up in the statistics, but I think that's what we're going to see. So that's an additional source of demand for silver from even if demand stayed flat in solar panel production. Now you have this whole added layer of batteries. The cost of batteries and to store the power in batteries is falling and expected to fall by half over the next 10 years. We already expect for 2025 that we're going to see battery installations at 60% of 2023 solar panel installations. So that is really catching up very quickly. And I think the takeaway from battery and solar is that battery helps to make solar what I view as baseload power. Obviously, solar is there when you've got sun, and then the problem is nighttime. But if you can store the if you can store the power that you've produced from solar during the day and then draw on that at night, then you can have this constant baseload power, which you get from things like nuclear, for example, or natural gas, whatever it might be that utilities use, coal, whatever else. And so that just makes solar that much more attractive. Then you've got a few other layers to add to this. You've got the fact that, technology companies, most companies are looking to be greener. They're looking for sources of power that are considered carbon neutral, carbon free. Solar is considered one of those. And what we've seen is that you've got the large tech companies. Many of them quickly went to nuclear, but they were able to tap into underutilized nuclear capacity. And they have the billions or tens of billions it takes to, lock that up very quickly. And because it was untapped or dormant, you can kind of bring it back online more quickly. But if you're looking at new nuclear, you're looking at 15 years. Compare that to solar, you're looking at a year and a half to get a solar farm up and running. So it's a tenth the time that it takes. And we've seen uptake from tech companies in the US adopting different kinds of power. They're adopting they're adopting solar to the tune of 5 times faster right now over the past year or so. So you see that solar is certainly attractive to them. And you're not depending on a utility that's producing the power and to be connected to that utility. Many times you can actually have, if you've got the land to build out the solar farm, you can be completely off grid, so to speak. So you've got your farm, you're drawing the power from your solar farm, and you're not depending on someone to provide this power to you. So that's very appealing. Absolutely.
If it's your solar farm, then your price for your energy is fixed at maintenance costs, essentially. All right.
One other aspect to that, if I may, Ernest, and that is what we see in terms of projections for power demand in 2 ways. One is data centers have become a huge thing in terms of requiring power. We're seeing that in the U.S. in particular, where we get a lot of the information regarding that. Data center electricity growth is supposed to be on the rate of about 22% over the next decade. AI power demand is supposed to grow by 31% annually over the next decade. So these are just almost exponential growth levels in these inevitably unavoidable sources of demand for more power. And as we've just talked about, solar is likely to be a key source of that power. And again, silver in the solar panels, silver in the batteries, crucial.
Mm-hmm. Now, there's also been another major change from last year when we were speaking. Last year, the silver growth story was very much green energy, and it was this kind of positive framing of we're going to pivot away from polluting sources of energy and into green. This year, it's much more of a critical minerals conversation. So how does this change? Because now all of these minerals and these supply chains, this long-term demand is being driven partly by the market. I mean, as you've said, with AI, but the government is now very much at the table in terms of trying to secure long-term supply, trying to protect, state-level long-term interests for, can we build out our military? Is all of our industry vulnerable to shocks, outside shock? So obviously, a lot of these same things are happening. The solar build-out continues. The demand from industries that needed it last year will need it this year and beyond. But how does this change of a framework to more of a critical minerals framework? How does this kind of change the calculation for companies that are trying to project 5, 10, 30 years into the future?
So I believe it helps to make them more confident, I would say, in terms of where silver prices are going to be. These are cycles. And mining executives are not, they can't escape some of the mindset that comes with. But I think that silver is now viewed as much more critical and crucial for industry. We see investment demand, of course, ebb and flow, but there's at least anecdotally some in the last couple of months, we've seen some tremendous stories about people flocking to bullion dealers and buying silver. But the mining executives now, I think they can be more confident of higher and sustained higher silver prices, so they'll be more willing to commit to exploration, to expansion, to acquisitions, and it's a small space. So I think that's important. The critical mineral side of silver, I think, is absolutely a new dimension that has has been added to the silver sector. In the US, they have a critical minerals list. As we speak, to my understanding, it's only on a list where silver is being considered along with other metals to end up potentially on their critical minerals list. So it's being reviewed and considered, partly because of the government shutdown that could take a little while longer to get a final answer on. So we don't know. Will that happen? Will it not happen? I think it's significant just that it's been added. This is the first time it's been added to be for consideration. What we have seen, one thing to keep in mind too, Ernest, is that 43% of all of the silver consumed in the US is imported. So nearly half of all the silver they consume, they have to bring in from other countries. So they're certainly not self-reliant when it comes to silver, far from it. And again, sort of an aspect of critical minerals and what we've seen happening. And it's interesting, how you've pointed out that the solar aspect of silver was a more sort of widely seen way that everyone was kind of on board, and it might have been more partisan in some ways. It was encouraged more by some administrations and so on. But this fact that silver may be considered more and more as a critical metal is something that I think all parties are going to be on side with. The world's becoming deglobalized. It's becoming more regional. And we've seen in the US, the administration has taken steps that we have not seen happen for a long time, where they've started to buy into companies. And, we've seen that a little bit on the tech side, but now we're seeing it on the mining side. They're taking meaningful positions in companies that have critical minerals. Lithium, for example, copper, for example. They're starting to streamline permitting. They're making it easier for these projects to come on board and eventually get built out and produce. So we're seeing a lot of support politically for critical minerals and silver potentially in particular. So that absolutely is a new dimension. And I think that is just one more thing that makes sustained high silver prices just that much more likely.
Right. And then perhaps the biggest factor this year compared to last year is that we now have generalist investors piling into the silver space. So you can explain probably a lot of the price move in silver because all of everything we've spoken about until now are medium and long-term drivers. They can be magnified, they can be reframed, but this was all happening. But investors piling into silver, which is usually when silver really moves, that has now happened. So what are ETF flows telling us about investor sentiment towards silver right now?
So we've seen since I believe it was June of last year, we've seen a bottoming in SLV, which is the largest silver ETF. We've seen a bottoming in its silver holdings. They've started to climb on balance ever since then, continue to climb. So that's a definite change in mindset. We've seen anecdotally, bullion dealers are being overwhelmed. We've seen this in China. We've seen it in Singapore. We've seen it in Egypt, for example. People are waiting in line. They want to buy silver bars, silver coins. What we've also seen is that what I find interesting is the numbers. So the Silver Institute forecasts that this year we're going to be somewhere around 200 million ounces of demand for physical coins and bars. I feel that that's kind of low. That's about equal to industrial demand for solar alone. So a little bit of perspective. Solar takes about 200 million ounces of silver. Let's start at a little bit higher level. Again, I think it's useful to understand sort of the big picture. There's about 1 billion ounces of silver supply every year between mining, about 85%, and recycling, about 15%. Mining has been flat, in fact, down over the last 10 years. Recycling has been flat for 10 years. So we're not seeing any new meaningful silver come to market from either of those. Where we could is if silver prices are high enough for long enough, where we've got silver being owned by individuals and others, they may start to sell it back to the market and help with supply. But for now, we haven't really seen that happen. So silver supply is flat, demand is growing. Demand is at least 15% above supply. So 150 million ounces above. Solar takes 20% of all of the silver. Jewelry takes 20% of all of the silver. And investment demand is expected to take 20% of all of the silver. As I say, I think that investment demand, when we get the numbers for 2025, I think that will have been lowballed. I think that it's going to end up considerably higher. And interestingly, the Silver Institute does not include ETF silver in its calculations for demand. And their reasoning is that, well, this is silver that's held in an ETF. It's not consumed like industry or like jewelry. It could easily flow back. And my argument is, so is physical silver, investment silver, silver bars, silver coins, and yet those are included. And so I can't square that. But if you include the demand that's flowing to silver ETFs, then the market balance, in other words, the overall deficit, is going to be the third highest deficit in the last 10 years. So that changes the perspective. And that's why I think that it's one of the reasons I think that investment demand is being underestimated, underappreciated by the market. Another point to consider is that 10 years ago, industrial demand was about half of all silver demand. And if you add the rest together, most of which is some form of investment, jewelry, silverware, coins and bars, was about the other half. Now industrial demand is about 65%. So it's grown tremendously, gone to 2/3 from half. What does that mean? It leaves a lot less silver for investment demand, right? Because industry is not going to say, well, I don't need my silver all of a sudden. They need it. And what we've seen happen in the last few months, I think, has certainly been indicative of industrial consumers saying, I need my silver. It doesn't matter the price. So that, with investment demand layered on top, has led to, this pretty explosive run up. But to my previous point, if you've got industrial demand growing the way it has, squeezing out the portion available for investment demand, all that means is that when investment demand comes back in a big way, it's got less silver to buy, right? There's less silver available to meet that demand. And so what happens? Price reaction. It pushes silver price up. And I think we've started to see some of that happen now. I think we're going to see a lot more of that.
Right. Well, you touched on supply. So let's get into supply now. So I guess in the near term, the most dramatic thing we've seen with supply are just disruptions in the physical supply and storage of silver. A lot of that driven by threats of U.S. tariffs. So can you just catch us up a little bit on what's the state of the physical market between London and New York now? So
it has actually eased in the last sort of week or two, which is, I think, one of the reasons we've seen silver back off from, say, 54 to 46, 48. There was a lot of... So London is sort of the center for ETF silver storage. And that aside, because of arbitrage, because of concerns in the US that there would be tariffs on silver, a lot of silver had flowed out of London into New York. In fact, normally, because silver is bulky, usually you ship it. If you're not in a rush, you ship it. But because of the arbitrage opportunity and because of the pressures, a lot of it was flown. So, some of the dealers wanted it there very quickly. So a lot of this silver moved to New York. There was still demand for silver out of London, and that caused a squeeze. And we saw the silver price move up. We saw supply dry up dramatically. We saw things like in the futures markets, we saw what we call backwardation. In other words, the near-term price or physical silver was more expensive than the longer-term silver contracts, which is not the normal contango state of things. So not typical. We saw lease rates go up to 39%. The day silver peaked at $54. All of these are big indicators of dislocations in the market. So there's no doubt that the physical market was very tight, and we're starting to see, and I think we're going to see this a lot more, and ultimately it's going to be the new way, but that it's the physical market that is now going to start determining the price as opposed to the futures market, the paper market determining the silver price.
All right. Well, that's encouraging, and in the near term, that's easing somewhat. But we still have this. This is all happening against the backdrop of multi-year supply deficits. So, what is the? We do, on the one hand, we do seem to be avoiding a U.S. recession. Now, this was something that was supposed to potentially slow demand for silver. So we're avoiding the recession. We were still getting the rate cuts. What's the latest, given all of these factors, you were talking about how they're consistently underestimating the demand in terms of build out. What is the impact of this on the supply picture? Because now, like you said, we've had flat or slightly down mine production. We're not seeing a lot of recycling coming into the market. So now, what's the latest calculation? I guess, what are the baseline calculations? And then how would you adjust those baseline calculations based on all this new information, some of which is just a few months old?
So when you say baseline calculations, are you talking about
previous estimates of this long-term supply deficit?
Right.
And then are we potentially undershooting those estimates at this point?
I think we probably are. I mean, something very notable from the Silver Institute from this year's World Silver Survey is that they forecast that we're going, despite this year, I certainly believe it's almost certainty we're going to have another year of deficit. So that'll have been 5 consecutive years. And they forecasted, to their credit, I think, that over the next 5 years, we're going to have continuing deficits of silver. But not only continuing deficits, but new record high deficits of silver. So, silver is considered supply inelastic to price. In other words, the price may move up, but it's not an economics 101 where if the price moves up, you get more of that product coming to market to meet that supply. Part of the big reason for that is that about 25% of silver comes from primary silver mines. About 75% comes from as byproduct production of silver. In other words, mines that mostly produce copper, gold, lead, or zinc, but produce a little bit of silver. So if you think of it from the mindset of that miner, they're looking at this and they say, well, silver price is $48, silver price is $50, silver price is $55. Interesting. Great, I'm happy to accept this higher price. It's a small portion of my revenues. Am I going to do anything about it? Probably not. I'll just accept the higher price. And even if they could, it's not that easy to react and try to, crank up your mine and produce more silver or more of all of your metals. So they'll accept the higher price and keep producing the same amount of silver. That's one of the big reasons that silver supply is price inelastic. It does not react to higher prices. That just exacerbates things. So again, all of these things, these higher prices, they do make the miners more confident in terms of when they look out and they have to project where silver price is going to be in 3 years and 5 years and 10 years. And so they, I think, are going to be more willing to invest in production, invest in exploration, and the larger ones are going to be more willing to react the easier way, and more quickly, especially if they can use to some extent their share price as a currency, which is now higher, right? Because these prices have moved up, to go out and acquire some of the smaller explorers, some of the smaller producers. We've certainly seen some pretty big movements in terms of M&A on the higher end of the silver spectrum. So, we've seen Kerr buy Silvercrest. We saw First Majestic buy Los Gatos, or Gatos Silver. And then we saw Pan American buy, it's escaping me. They bought Mag Silver. So that's 3 big ones, meaning we've gone from 6 big ones. Well, there are a few others, but we've gone from 6 big ones to 3 big ones. The space is shrinking, As I say, it's a lot easier to go out and buy than to look for. And the delay is, you discover what is an economic silver deposit. It'll take you 10 to 15 years. The governments are likely going to be, supportive and help streamline things. Even if they cut it from 15 to 10, that's still a decade out. Very likely silver demand is not going down. Very likely it's going up, and mine supply is going to be unable to react. We've seen more elevated prices in silver. We've seen almost zero reaction when it comes to recycling to answer that need for more supply. So all of this is very encouraging and pointing to a higher silver price. That's what it tells me.
Right, and it's interesting on the recycling front. People will sell their silver back into the market, not just because it's up, but because they think it's peaking. If there's no expectation that silver is peaking, then the fact that it's at all-time highs doesn't make anyone want to sell. It makes people want to potentially buy. It's a vote of confidence in silver that silver prices are so high. And the fact that gold isn't massively retracing, a lot of the people on the silver side look at this and they might think, okay, I've got all this silver, I've got my stack, I've got my coins, I've got my holdings, whatever they are. Why would I be selling now? Silver's not falling back down to 30. I can sit here at 50. I can sit here at 48, and let's see what happens next. So a lot of those assumptions about at very high prices here comes the recycling supply. At very high prices people hold even tighter, and they're looking for opportunities. So that could also exacerbate that.
I agree, and I've been saying that for some time. That's been my argument when others have said, well, when there's this surge in demand, there's always these secondary private hoards of silver that at higher prices will come to market. And I just think that we're not in the environment where a little bump in the silver price is going to make people bring that back to bullion dealers and help with supply. I think we are in a different kind of environment. People are sensing it. In my recent presentations, I talk about inflation expectations. Right now, according to University of Michigan, looks at consumer surveys, they see consumers expecting a year out from now that inflation is going to be 4.8%. That's what they feel that they're living. And, we're being told official inflation is 3%. If you own some silver, are you going to be willing to part with it when you think inflation is more like 5%? If you look historically at how silver prices have behaved, and you just on official inflation numbers, if you adjust for US CPI inflation, the peak in 2011, so not all that long ago, of $50 temporarily, would have to be more like $72 or $73, I think, right now, if not higher. Again, with official CPI inflation, the peak in 1980 at $50 would be more like $200 today. So I think people see this, they feel what prices are like. I think higher inflation expectations are now embedded. They don't think that we're going back to 2%. I think, frankly, 4% eventually is going to be the new 2%. And I think people see that and feel that, and that's why we are really in a different kind of paradigm and environment for silver, but precious metals and metals in general. Almost all kinds of hard assets.
All right. So given that so many of these assumptions, so many of our previous assumptions, kind of have to go out the window in this type of an environment for all these reasons, what should we be projecting? So each time I speak with you, the projections go up, but they go up for very concrete reasons. They go up based on metrics. What are the key metrics that you're looking at to benchmark silver prices today and where they could go in, say, 2026? Let's say end of year is too soon. So let's say next year. What are we looking at to determine? Obviously, we have the fundamental supply and demand. We have supply deficits. We have growing demand. But when we look at this based on price, for example, so much of the price could be explained by investors piling in. Now, what are we looking at in 2026, and what could be the impacts on price in this environment?
So one of the things that I've one of the sort of concepts that I like to repeat is that I believe that industrial demand, because it's so steady and it's growing, it helps to provide a rising floor under the silver price. And then you have the investment demand that ebbs and flows, comes and goes. And when it flows, it really helps to push. So that's when you get these more sort of explosive reactions in the silver price, and they will come and they will retreat. But I think it's, about 15 years ago, I wrote an article called The Golden Staircase. And it was from looking at a longer term chart of gold, going back to say 2000 or so when it bottomed. And what struck me, just looking at the chart, is that you had these rises and then a sideways movement, and then a rise and then a sideways movement. Each time you had that, it looked like a step in a staircase. And so that's why I said, we're living a golden staircase. And with more volatility, I think we're going to start to see something similar in silver. I think we're going to see these rises. Maybe it won't be a flat step. It'll be a drop. But if you kind of average it out before it starts to move higher again, you have these peaks, retreats, and then eventually sideways movement, and then a new run up. And I just think that, if you look at, so we talked about industrial demand, the investment demand that ebbs and flows. Honestly, we're in an environment now where you look at things like the gold silver ratio, you look at other assets like the Dow, the S&P. If you look at a ratio of silver to the S&P, we peaked in 2011. These things take often, if you look at general stocks like the S&P versus silver, you see very, very clear. It's very useful, I think, to look at these charts, because you see very clear overvaluation of silver and then undervaluation of silver. And we're clearly in a period of undervaluation of silver versus general stocks. That chart has done this in 2011 and then is doing this right now. And this could take about, as I say, maybe a couple of years to play out, but we're clearly starting to trend back up. And what is, assuming it continues to play out as it has, and we have this new cycle continue, and that ratio starts to trend up again, you can have silver move up, you can have stocks move down, you can have different kinds of combinations of these things, but I think that's the most likely one. Silver were to continue to move up, stocks are likely to peak, and that to me is one big one that points to higher silver to come. You've got the gold silver ratio. What I find interesting is that, these are moments in time. When you look at the ratio, you're looking at a gold price, you're looking at a silver price, and you're saying, okay, it takes this many silver ounces to buy 1 gold ounce. Well, on the mining side, what I find interesting, Eric Sprott has some great way of looking at it. And of course, he takes considerably leveraged bets when it comes to his mining plays. But he says he believes one of his big advantages, and I'm sidetracking a little bit, but it just came to mind. He says he believes one of his big advantages versus other investors is that compared to, let's say, analysts or mining executives, he doesn't use, these considerably below spot silver prices when he's evaluating a project and the potential for a company. He uses current spot prices because he truly believes that, with some variation, some potential for volatility, it's indicative of where we should be, and probably conservative in terms of where we're going. And so to relate that back to the gold-silver ratio, you can look at the ratio at a moment in time. Right now, gold is around 4,000, silver is around 48. And if when we're in this kind of environment where silver is doing very well and catching up to gold, and I'm assuming that I do expect that to continue, the ratio typically compresses. In other words, it goes down. It takes less silver ounces to buy 1 gold ounce. So you can make your assumptions and your calculations in different ways. And one of the first ones would be to pick a gold price. So let's say we assume gold is going to stay at $4,000 or continue to average around $4,000. And if you if you assume, again, historically, that's what we've seen happen in bull markets for precious metals, silver starts to outperform, the ratio starts to come down. And even if it may have averaged, let's say over the last 20 years, 68, 69, I would think it tends to overshoot when it corrects. So I would think, we could easily expect it to go to 55, 50-ish. If it goes to 55 and we have gold around 4,000, we're looking at almost $70 silver. So how long will that take to play out? I don't know. Could take a year, could take a couple of years. But, silver starting to move a couple of chunks of $10 up is, I think, very realistic. One other thing to maybe consider, and because we're in a rate cutting cycle, is that I came up with a chart about a year and a half ago where I looked at what happens to the silver price. When I saw what would happen to the gold price in rate cutting cycles, I thought, let me apply this to silver and see what comes out. And so when you have the Fed cutting rates, typically gold will start to take off almost immediately. And silver reacting differently, partly because it's an industrial metal and there's always this concern of a recession and will demand fall back. I think that's what causes the lag. And we have the benefit of hindsight, and we can see that about halfway through these Fed rate cutting cycles, silver tends to bottom. So what's impressive is if you look at the average of the last 3 rate cutting cycles, silver gained 332%. If you assume, now the timing's a little bit off this time, I'll be honest and admit that in terms of where silver bottomed, because silver, for me at least, in this cycle bottomed around the end of February last year, around $22. I believe that's where it was. We're now, I believe, at the midpoint of the Fed rate cutting cycle because they paused and now they've resumed. In any case, if you use the bottom from last February and you project upwards, that would take us to $95 silver. So, it's anybody's guess. Where is the end of that rate cutting cycle, or at least where is the end of the run up in silver before a significant pullback or whatever?
But somewhere between 70 and 95 is still,
right.
There's a lot of room to run.
That's a lot of room. And think of we could talk about what that might do for the silver miners.
Well, that was I don't want to keep you here forever, but one of the things I wanted to ask you is what are some of the companies, could be majors, could be smaller producers or explorers that you're watching, given all of this, given the amount of value that remains, according to all these calculations, the amount of value that remains in the silver market. What are some companies? What are some stocks that you're keeping an eye on?
So there are some that I'm going to sort of stick to the bigger names that are somewhat lower risk. So some of the ones that I like and own are companies like Aya Gold and Silver, a Montreal-based company. We've got Skeena, which is developing the SK Creek mine in British Columbia. That's a tremendous project. I think it's a Canadian Mining Journal has for several years running considered it the world's most valuable resource project. So quite impressive and doing a tremendous job with that. We've got Go Gold that is operating in Mexico. They are operating a tailings processing facility that brings them significant cash. But the leverage there is that they have Los Ricos project waiting on a permit for that. And that I think is going to bring a lot of alpha to the stock once that gets going. There's also Cerro de Pasco, which has what is considered the world's largest above-ground metals resource. That's in Peru, 400 million tons of metal. This has been in some form of constant operation since about 100 years. It was formerly owned by JP Morgan himself and was listed on the New York Stock Exchange. So some tremendous history for history buffs there. And there's a lot of silver in this pile. Eric Sprott is a big investor in this company. Adds to obviously some credibility. He's a big investor in a lot of these companies, to be fair. But Cerro de Pasco is working on different aspects, doing plenty of drilling, proving up the resource that they have in terms of quality based on drill results and historical data and so on. But these are some great plays that people can look at. I believe all four of these in different ways are, medium-ish kind of risk. They're more advanced kinds of plays, and I think they can offer a lot of leverage on higher silver. So these are some ideas to look at.
All right. Well, we'll have to look at that. We'll also have to stay in touch because the silver space, especially this year, is changing so quickly. We've seen so much movement just since the spring until now. It feels like we've had 3 different eras of silver. So we'll have to keep in touch. We'll have to have you back.
Good. Thanks very much.
Stay tuned for more from Xplor 2025 in Montreal. I'm Ernest Hoffman for Kitco Mining. Subscribe to our YouTube channel and make sure to follow all of our updates.
Kitco Mining special coverage of Xplor is brought to you by Radisson Mining.